I don't think a single thing in the last quarter has changed in the underlying fundamentals of the majority of businesses that are public. And I actually think for the most part, nothing has really materially changed for the majority of private companies. All that's changed is what you're willing to pay in the future for it. And the one thing that hasn't changed is what you're willing to pay in the future for the private businesses. So the real question, for Sachs and, for the active investors in the private markets, which I don't know what to think about, is will the haircut that we've all taken in the public markets spill into the privates? And
it's starting. But it feels to me, it's not just about what's going to happen with new emerging growth companies. But I mean, you guys correct me if I'm wrong, but there are hundreds of companies that have raised billions of dollars at valuations that if they look in the public markets now, they are never actually going to achieve if they were to go public in the next 3, 4, 5 years based on their projections.
So to your point,
so
there are 900 unicorns right now, 900. And so once you get to, look, it's one thing to be a $200 million company and sell to Microsoft or whatever, but when you're a $1 billion company, there are very few buyers.
And I just want to point out there's a huge disincentive for an investor or a shareholder, a VC or a private equity firm, to take a big write-down on a company like that. And so there is always this push to what do we do next? And it creates this certainly, I'd love your point of view, but this really like unhealthy tension, because to take a write-down on 900 unicorns is going to cause a write-down of hundreds of billions of dollars across all VC portfolios in aggregate. Because they're not going to end up going public at,
sorry, just to finish your thought, because the end market is only to go public. There are very few companies.
No M&A exits. Yeah.
There are no, and not in the billions of dollars, because you have to think big tech is off the sidelines. Okay. Even if you look at like Visa and MasterCard,
they're not going to be allowed to do big deals.
Nobody's allowed to buy these big companies.
There'll
be
mid-tier
M&A.
I have an example that I could tell you.
Mid-tier maybe, but my point is when you have 900 companies worth $1 billion and plus,
they have to go public.
And so you can't go public into a valuation framework that values you at 30 to 40% less of your last private mark.
Right.
Yeah.
That doesn't work.
You did have...
Or do you, Chamath?
You actually do.
So this is an important question, because isn't that going to be the case that all these VCs with the 2015, 2016, 2017, 2018, 2019 vintage are going to end up having... They've all got these great marked books right now. The books are all marked to 3x, multiple on invested capital. And now they're going to end up having these liquidity events that are going to come in at shockingly low valuations. And there's going to be this great write-down and retrenchment.
I can tell you there's a couple of examples. One is The Athletic yesterday, which had raised money at $500 million just 2 years ago, just sold for about $500 million to the New York Times. And those investors basically put money in and they got their money back. It's a push. So I think you're going to see a lot of these pushes. Point. No, I'm agreeing with you. Yes, I'm going to give you the examples.
Then there's also mid-tier acquisition by a mid-tier acquirer.
And so there'll be plenty of those that occur. So there'll be a lot of pushes, I think, is my prediction of those 900 unicorns. And then for a lot of these SaaS companies...
So you're saying you think that a bunch of them are going to sell for under $1 billion, and the VCs, because they have preference, they're going to get their money back?
Correct. I think it's going to be a lot of these pushes where, I don't know, what is it in blackjack, David, when you're playing those three hands and you get a push? And it's like, okay, I'm going to live to fight another hand, now which we've seen Sachs do a number of times. And then for the SaaS is where Sachs, I'm interested in your position, because we saw in SaaS, all of a sudden, the private market, 30, 40, 50, 60, 70 times top line. And now it's gone back down to 20, 30, 40. So those companies now basically have
they?
Three.
The public markets have, but I don't think the private markets have.
In the private markets, it has happened already. Everybody's pausing. And so for the people who raised that 50x, congratulations, you did the right thing. If you have enough money to fill in that valuation.
Is it a congratulations, though? I mean, it seems like they're in a pretty tough position now. You just raised money at $1 billion valuation with 10 million of revenue. You're like,
or 20. Let's say 20 would be the more likely.
I mean, like, what are you going to do? What are you going to do in your next round? Because you're burning 100 million a year now, or 40 million, or whatever it is you're burning.
Almost all the companies I've seen in this exact situation you're talking about have that 20 million. They got $1 billion. They raised 100 million or 200 million, and they're basically now saying, okay, we got to make this last until we can catch up to that valuation and get to 50 to 75 million. So I think I would take that deal as a founder and as an investor, because it takes out the downside, and now you just have to worry about catching up to the valuation, and you have 4 years of runway. They're not going to, they're going to right-size the spending.
No. Those
That's what I'm
companies do
saying.
not. Those companies absolutely do not have 4 years of runway. I will bet dollars to donuts they have 2 years or less, and most of these companies have 18 months.
Which means they got to be raising in 6 to 9.
No,
Correct.
they're changing their spend and they're changing
How
their
are they
targets.
changing their spend? They're not firing anybody. You're not hearing about layoffs at startups.
Okay, all right. You're not hearing about it, but maybe they're changing their forward-looking growth plans. What are you seeing, Sachs? I'm telling you what I'm seeing. What are you seeing, Sachs?
I think that the trickle-down effect is inevitable, but I'm not sure it's fully kicked in yet. It's going to take a few high-profile deals to land at, say, 50 times ARR instead of 100 times ARR in order for everybody to know that there's a new valuation level. So if you look at the altimeter chart on public SaaS multiples, let's see. I mean, Nick can pull it up. It's the SaaS index. It shows median expected value to next 12 months revenue. And during this sort of late 2020, early 21 period, it got as high as about 15 times the historical
next
average.
Year.
Yeah, for next 12 months revenue. Which is sort of, that kind of makes sense. So historically it's around 8, right? So basically all the valuation levels doubled and now they've come down to about 10 times. So you could say that if it fully reverts to the mean, we still got like another negative 20% to go. I don't know if that's going to happen. I mean, I think there has been a greater recognition that SaaS businesses are some of the best businesses to own, right? They are subscription software businesses, great gross margins. They just keep compounding. So maybe it will stabilize at 10 times. But I think what we can say with 2020 hindsight is that the record price levels we got to in the public markets in 20 and 21 were sort of unusual and unique and probably the result of this incredibly expansionary fiscal and monetary policy that was coming out of Washington. Now, has it trickled down to again, VC markets yet? I mean, the way that has to happen is that the latest stage investors, the crossover investors who invest in both public markets and private markets, they have to start paying less for the latest stage growth companies. And then, all the downstream VCs are going to start paying less as well because, if the markups are lower, you have to take that into account. So look, all of this is underway right now. I mean, I gave a Bloomberg interview in December, and I think I went on Maria Bartiromo's show around that time as well, and I kind of warned that all of this was coming. And we're in the midst of a giant re-rating because we're realizing that so much of the peak values we were seeing in 2020 and 21 were the result of artificial liquidity.